to today's report, the 21st of March, 2025. Right, today I want to talk a bit about the FOMC meeting update. Fed holds rates steady as uncertainty looms. Okay. Now, as its latest Federal Open Market Committee, or better known as FOMC meeting, the Federal Reserve maintained its benchmark interest rate within the 4.25% to 4.5% range, unchanged since December 2024. Now, however, the Fed's economic outlook for 2025 has become more cautious, with downwards revision to key projections. The Fed lowered its GDP growth forecast for 2025, adjusting its previous 2.1% projection to 1.7%, signaling concerns over economic momentum. Now, simultaneously, the unemployment rate is now expected to rise to 4.4%, up from 4.3% in December, reflecting potential labor market softening. Okay. Now, inflation projections also saw an uptick. The PCE, or personal consumption expenditure inflation, for 2025 is now forecasted at 2.7%, a 0.2 percentage point increase from prior estimates. Whereas the core PCE inflation, which excludes volatile food and energy prices, is expected to reach 2.8%, reflecting a 0.3% percentage point rise. Okay. So this adjustment suggests that the Fed remains wary of inflationary pressures, with uncertainty surrounding policy decisions under the Trump administration contributing to a more conservative stance. So look at over here overall, the Fed is policy stance turns more hawkish. Now, why do I say that? Now, this is the dot plot right here. Now, given these economic conditions, the FOMC stance has become increasingly hawkish. Now, 4 committee members now expect no rate cuts in 2025, as you can see from the dot plot here, has increased to 1, 2, 3, 4, a significant shift from just 1 official at the January meeting. Now it's increased to 4 right here already. All right. So one unexpected outcome from the Fed latest projection was its decision not to increase the number of anticipated rate cuts in December 2024. Right? The forecast remains unchanged at 2 cuts, keeping the projected interest rates between 3.75 to 4% at the end of 2025. Now, this suggests that Fed Chair Jerome Powell and his colleagues are adopting a more patient approach, opting to assess the full economic impact of tariffs on inflation before making further policy adjustments. Now, explaining this stance, Powell characterized the overall economic outlook as stable but highlighted growing risks. He pointed to survey data indicating a significant rise in uncertainty, with both households and businesses expressing increased concerns about potential downside risks. Now, moving forward, close attention will be paid to shifts in the Fed's dot plot. Okay, so we have seen 4 already, particularly regarding any increase in number of policy makers favoring a more hawkish stance. Now, the question here is that will there be more moving towards that area? Because if they are projecting economy, inflation is going to go up, right? How they might, you might have more and more saying that we're trying to maintain the interest rate at the higher rate. We just cut twice and that's about it. But at the same time, they have to ensure that nothing happens to the economy, because you're saying that GDP is going to come down already, and so on. Basically telling us that the report card, going forward, the economic report card for the US is not going to be good, right? That is also a headache on its own, because they need to control unemployment. They are already given another 0.1% increase for this year. They have to manage this well, and by maintaining higher rates, I don't think that's going to help. Okay. But like I said, it is more to me like something uncertain at the current moment, and they're just being patient and wait and see, especially April the 2nd, to have a better idea. So what are the market implications? Is it a step towards easing? Now, key development from the meeting was the Fed's decision to scale back quantitative tightening QT. Now, the Fed will reduce a monthly runoff of treasuries from 25 billion to 5 billion right now, providing additional liquidity to the financial system. Now, if you're not sure what QT is, refer to the previous report that I gave on Wednesday, okay? Now, however, the 35 billion cap on mortgage-backed securities remain unchanged, though it's rarely been met. So these adjustments represent a notable step towards potential monetary easing already, aligning with market expectations for future quantitative easing. Now, for those that are still new, I don't know what QE is. Basically, in layman language, printing money. Yes, putting back liquidity into the market. QT is removing liquidity, i.e. money from the market. So this is putting money back into the market, right? So as a conclusion, yes, Trump's strategy appears to be unfolding as expected. By introducing tariffs and economic uncertainty, he is effectively applying pressure on the Fed to first halt quantitative tightening and then pivot towards rate cuts. Now, this sequence aligns with his broader economic playbook, which historically favors lower interest rates and looser monetary policy to stimulate economic growth. Okay? So, if the Fed follows this path, the next logical step would be the return of QE once economic conditions weakens further. This move would flood the market with liquidity, typically resulting in higher asset prices across stocks, real estate, and risk assets like cryptocurrencies. Now, the key question is whether the Fed will resist or yield to market pressures. Powell has signaled caution, but as economic data deteriorates, market expectations of policy easing will intensify. Okay, so yeah, that's the report for today.